Hi, this is the first video in a series of videos in which we'll cover accounting for investments under US GAAP. And here's an outline of some things we'll discuss in the videos. Okay, so the first thing we'll cover is investing in a debt security. So what I mean by that is a corporation buys the bonds or the stocks of another corporation. They have either a debt or equity investment. The FASB's decided that the way you account for this type of thing depends on whether it's debt or equity, and it also depends on your intent with respect to that investment. So in this video, I think we won't get as far as equity. We'll definitely, we'll just talk about debt. Debt securities. This is a nice little chart here. If management has no plans to sell them, we account for it using the amortized cost method. So we just account for it at what you paid for it at the cost, and we amortize any premiums or discounts, which makes a lot of sense if you think about it. If you're not planning on selling the bond, why do you care if the market value has changed a lot? It's irrelevant to you. If you do plan to sell it, if that's your intent, then you would care if the price changed. And so investors would definitely want to know changes in the value of it. So if you do plan to sell it, the FASB says you have to account for it using the fair value method, meaning you update your balance sheet and as the value changes, raising or lowering it. Okay, let's put this up here. Oops, go back. Okay, so with debt, you have three categories. Held to maturity, that's the kind you have the ability and the intent to hold until maturity. You buy a bond, you have no intention to sell it. You're going to collect the interest and the principal at maturity. And again, we account for that at amortized cost, not fair value. And we amortize any premiums or discounts associated with that using the effective interest method. Okay, that is one category. The next category is trading. And those are debt securities that you buy primarily to sell in the near future. You are hoping to generate some income here based on short-term price changes. You believe the price is going to go up. That's why you bought it, and you're going to sell it as soon as it goes up. What's in between is the third category, available for sale. So for those, you're not necessarily saying that you're going to hold them to maturity, but you might. They're available for sale. That's hence the name. You could sell them if the price went up substantially. All right, and here's this chart really does it all. This is the key chart for the. This is a big part of the chapter here. Held to maturity, accounted for an amortized cost. What do you do? The point of this chart is to show you two things. What do you do with unrealized holding gains or losses? By unrealized, what I mean is, you buy a debt security, its value goes up, but you don't sell it yet, and the fiscal year ends. You have an unrealized gain. If you actually sold it, then it would be a realized gain. Okay, so that's what unrealized means there. So again, if you're doing amortized cost, the unrealized gain there, or loss, doesn't matter, whichever it is not recognized. There's no effect there. And there's other income effects. Pretty standard. You recognize interest income when you earned it, and if you sell it, then you recognize the gains or losses. Okay, that's pretty straightforward for held to maturity. That's how we would treat gains or losses on any other asset. Okay, then the other thing then is trading securities versus available for sale. Some key distinctions here. For trading securities, for both of them, you keep them at fair value. That's true for both of them. The difference is that the unrealized holding gains or losses, if it's a trading security, that means your company is saying that they plan on making money on short-term price changes. Those unrealized gains or losses are then recognized as part of your net income. They will go in your income statement there. Available for sale, on the other hand, we say, wait a second, available for sale, we're not saying that we bought them just to make short-term money off short-term price changes. However, the price did go down or up, so those unrealized gains or losses are recognized as part of other comprehensive income. You guys may remember OCI. Gee, sometimes this pen thing doesn't write very well. I don't know. Just try and write it again. Oh, that's working pretty well. OCI, other comprehensive income. Okay. And the other income effects are the same. All right. Let's walk through an example real quick. Zibo Company buys $100,000 of 8% bonds of Kieso Corporation on January 1st, 2013 at a discount, paying $92,278. The bonds mature, looks like 5 years later, and they yield 10%. The interest is payable semi-annually, July 1st, January 1st. All right. So what does Zibo do at the time they purchase these bonds? Well, here's what they do, guys. They debit an asset account called debt investments, and they credit cash. Pretty simple. Pretty simple. Here is the amortization table associated with that purchase. So you can see we're starting with our original carrying value of the bonds. They are 5-year bonds which pay semi-annually. So you can see the 8% of 100,000 times half a year. You can see the $4,000 cash received every 6 months. And you have interest revenue. Again, the yield is 10%. So you're taking 10% times that carrying value times half a year. That's where we get those numbers. I'm really sorry about this pen. I really don't understand why PowerPoint does this. But that's supposed to say 10% times CV times 1/2. And the third column is the amount of the bond discount which is amortized, which is calculated as, in the first row, 4614 minus the 4,000 gives you 614. And we just add that to the carrying value and take that new carrying value, the new carrying value there, multiply that by 10% times half a year, and we arrive at the interest revenue for the next 6-month period. Okay, beautiful. So then, we have our snapshot of our amortization table here. So on July 1st, 2013, that's the first interest payment we're going to receive. How do we handle it? Well, our cash goes up by $4,000. Debt investments will go up by the amount of the discount amortized, and we're going to credit interest revenue for $46.14. Okay, and then on December 31st of the same year, we need to accrue this interest revenue here, $46.45. So we have an interest receivable. Debt investments will go up again, and we are crediting the interest revenue. All right. So that is what it would look like on the balance sheet at that point in time, and the income statement, interest revenue there. Okay, so let's do the example a little further here. Let's assume that Zibo sells its investments in Kieso bonds on November 1st, 2017 at 99 3/4 plus accrued interest. Zibo would then record the discount amortization as follows. So fast forward. All right, that's what these arrows mean. We're lower on the amortization table. We are now somewhere between these two lines here of July 1st, 2017 and January 1st, 2018. Let's see where we're at. July, August, September, October. Okay, so 4 months. We're 4 months into the 6-month differential between these two dates. Okay, so if we're going to sell them at this point in time, we got to update the discount amortization. And as you can see, it was supposed to have $952 amortized if we were on schedule. But because we're selling it on November 1st, we're 2 months before that day, we're just going to take 4 out of 6 months of that, equals $635. All right. So debt investments go up by $635. and we're going to recognize that much of interest revenue at that point in time. And then let's account for the actual sale after we have updated this discount amortization. The gain on sale of the bonds is going to be $67, and you can see how that's calculated right there. You have the selling price of the bonds, exclusive of the accrued interest, less their book value at that point in time, plus the discount we updated there. Okay. So there you have it. There's the gain of 67 to make the debits equal the credits. Okay, and that is enough for this video.